Ever strapped yourself into a roller coaster but like blindfolded? Kind of feels like that sometimes with crypto, doesn't it?
Uh-huh, yeah, I can see that.
Especially, when you hear stuff like 70% of crypto investors are like bracing themselves for another crash. So are we really headed for another crypto downturn?
Hmm.
And if we are, how can we like ride these crazy waves without getting totally wiped out?
It's true. The crypto markets are known for being, well, volatile. But these ups and downs, they're not just random.
Right.
There's actually a pattern, a cycle. And once you understand that,
Yeah.
that's the key to not just surviving the roller coaster, but actually thriving in the crypto world.
Okay, so let's break down these crypto cycles. What is it that makes them, tick?
Okay, so imagine Bitcoin's price history, right? Especially around its halving events. A halving event happens about every 4 years. Basically, it cuts the rate of new Bitcoin being created in half. And historically, we see Bitcoin's price surge both before and after these events. But then, almost like clockwork, there's a correction, a big downturn.
Hmm.
Like we saw in 2021, Bitcoin hit that all-time high of $69,000, but then, bam, crashed down to $16,000 the next year.
So it's like this like boom and bust cycle tied
Exactly.
to these halving events. That's wild. Are there any other like warning signs, red flags, other than just the calendar that a crash is coming?
Absolutely. One big thing to watch is leverage trading.
Right.
Leverage basically means borrowing money to make bigger bets in crypto. And yeah, it can boost your gains.
Sure.
The thing is, it also makes the risk way, way higher. Like in the 2021 crash, 20 billion, that's billion with a B, dollars in leverage positions got liquidated when the market tanked.
Ouch. A very expensive lesson. You mentioned crypto whales before.
Yeah, yeah.
Do they like play a part in these crashes too?
Oh, yeah, they can. Think of a whale as someone who's holding a massive, massive amount of cryptocurrency, enough to potentially move the market.
Right.
So if one of these whales suddenly dumps a bunch of their coins, it can set off this chain reaction.
Hmm.
A wave of panic selling, prices plummet. It can get kind of ugly.
Gotcha. So we've got these leverage traders and these shadowy crypto whales potentially like shaking things up.
Right.
But what about the root causes? What are the things that really drive these downturns?
Okay, so one major factor is just too much speculation. Remember that ICO bubble back in 2017?
Oh, yeah.
People were pouring money into projects that, frankly, hadn't really proven themselves.
Yeah.
Prices went crazy, all based on hype and FOMO, fear of missing out. Then PF'd, bubble bursts, tons of value wiped out, just like that.
Poof. Gone.
Exactly. And then there's regulatory uncertainty. When governments make moves to restrict crypto, ban it, it can really shake things up, like what happened with China's crackdown.
Right.
And of course, don't forget about like the bigger picture, the macroeconomic factors. Like when inflation spiked in 2022, investors across all markets got spooked. Crypto took a hit too.
So it's like this whole web of factors. Sounds a bit overwhelming, honestly, especially for like newcomers. How can anyone even begin to navigate this crazy, volatile world?
That's where a good strategy comes in. One of the most important things is diversification. Don't put all your eggs in one basket.
Yeah, that's good advice in general.
Exactly. Spread your investments around. And a really smart move is to put some of your crypto portfolio into stablecoins.
Okay.
Things like USDC, they're designed to stay stable, pegged to a regular currency like the US dollar.
Right.
That way, you've got a cushion when the market's going haywire.
So stable coins, a bit of like stability amidst all the craziness. Makes sense. What about buy the dip, though? Classic advice. Is that something investors should like actually try?
Buy the dip can work really well, but you have to be careful. The basic idea is to keep some money on the sidelines, your dry powder. And then when the market dips, that's your chance to buy. Problem is, you got to know the difference between a real dip, a temporary drop that'll bounce back, and a downward spiral.
Oh, right.
Let's say Bitcoin's at $20,000 and you jump in with $1,000 during a dip. If it goes back up to $40,000, boom, you've doubled your money.
Nice.
But if it keeps falling, well, that's not so good.
Yeah, that's the risk. So buy the dip is a bit more nuanced than just like buying whenever the price goes down.
Exactly. It takes a good understanding of the market and a pretty strong stomach.
For sure. What about leverage? Is there ever a good time to like play with borrowed money in crypto?
Honestly, leverage is risky, period, especially in a market as wild as crypto. There's data from Binance showing that like 80% of traders using leverage end up losing big during crashes. So unless you're, a real pro, a seasoned trader, I'd steer clear.
Noted. Stay away from leverage unless you really, really know what you're doing. Any inspiring stories, though? People who rode out these crypto storms and actually came out ahead?
Definitely. The folks who held onto their Bitcoin during that 2018 crash, they saw their investments triple in value by the time Bitcoin hit its peak in 2021. It shows you, even in a market like this, you can succeed if you understand the cycles, manage your risk, and stay disciplined.
That's pretty awesome. So, to everyone listening, what's your strategy? Are you the HODL smart type, the buy the dip daredevil, or something in between? Let us know in the comments. Let's learn from each other. And hey, don't forget to like and share this episode with anyone else who's on this crazy crypto adventure.